In this video, I'm going to explain how a call option works. Be sure to watch it all. You're not going to want to miss the ending. Let's take a look at how the call option works. So, just to recap, we know that a call option gives the owner the right to buy 100 shares, and it's associated with an underlying stock. In this case, for this example, it's ABC Incorporated. And one option is the equivalent of 100 shares or controls 100 shares. There's an expiration date of September 27th, 2021, and the strike price is $105. All right, so there's some individual that owns the call option, and this person has the right to exercise the option, meaning they can use the option to buy 100 shares, and they're guaranteed to buy those shares at a price of $105 per share. So that's the strike price. Now, the expiration date is relevant because the owner of this option, they need to exercise the option before it expires, right? So they're required, if they're going to use this option, they have to purchase the share. They have to purchase the shares before the option expires. So the option owner has the right but no obligation to buy the shares. And so this means that they have the opportunity to buy the shares at $105, in this case the strike price, and they can do that before September 27th, 21, but they're not obligated to do it. Next, let's take a look at some of the terms or phrases that are associated with call options. And there are three phrases in particular that I want to bring to your attention. So the first phrase is in the money, the second phrase is at the money, and the last phrase is out of the money. So I'm going to go ahead and tell you what these are, describe a little bit about them, so you have a clear understanding of the definition and what they mean in regards to a call option. So the first one is out of the money. And this scenario occurs when the share price, in this case $104.99 or below. So when the share price is below the strike price, the call option is considered out of the money. So we see the share price is $104.99, which is below the strike price of $105. So any value below $105 is considered out of the money for the call option. Next is at the money, and this occurs when the share price is the exact same price as the strike price. So in this scenario, we see that the strike price is 105 and the share price is also 105, so the call option is considered at the money. And the last phrase, in the money, this happens when the share price is actually above the strike price, and so the call option is called in the money. So we see here that the share price is $105.01, that one extra penny or higher, anything above 105 is considered in the money. So now let's take a look at an example of an out of the money call option. We can see by the chart the investor actually has control of the call option with the $105 strike price. The current price of this stock, however, is $87.52, but the investor acquired the call option because they believe that the share price will eventually exceed the strike price. Let's see what happens. The investor acquires the call option with the $105 strike price at this point here. And now as we watch the stock price, we see that it never actually gets to the $105 per share level, which means this option is considered out of the money. And so the share price ends at $95.36, which is below the strike price. And so this call option is out of the money. Next, we're going to take a look at an at the money call option. And this is when the share price is the same as the strike price, and this is called at the money. For this example, we can see here that the investor acquires the call option with the $105 strike price at this point here. We're going to watch as the share price of the stock actually reaches $105 per share. and so our option contract is considered at the money. And in this last example, we're going to show a call option that finishes in the money. So that's when the share price is above the strike price, and so the call option is considered in the money. For this example, we can see here that the investor acquires the call option with the $105 strike price at this point here. So now let's watch the stock price as it climbs above the $105 strike price. With the share price over the $105 strike price, our option is now considered in the money. And as we can see from the chart, the share price is $106.44, which is well above the $105 strike price. So the call option is in the money. If you're interested in learning more about stock option trading basics, then be sure to check out my video, Option Trading Basics. I've included a link in the description below. Also, if you're interested in opening a trading account and receiving 2 free stocks, then consider opening a Webull account and using my referral link that is in the description. If you use my link, open an account and deposit just $100, you'll receive 2 free stocks worth between $8 and $1,000 each. So did you like this video and you want to see more like it? Well then smash the like button. It lets me know that you enjoyed the video and it motivates me to create more. And if you really want to know more about trading stock options, be sure to use the subscribe button so that you get access to all of my videos. Also, click on the bell icon so that you'll get notified every time I release a new video. I've been using a simple method to trade stock options and generate over $2,000 a month, and now you can see exactly how I do it. Make a plan, take action on that plan, and start living your dream.